Dear students, you might be aware of different forms of business organizations such as sole trading concern, partnership firm, joint stock company, cooperative societies. We are going to discuss about partnership firm and its advantages to the firm. Towards the end of the 19th century, need was felt to regulate and control the evils of contracts arising out of the partnership. Hence, law of partnership has assumed the great importance, and with the development and growth of business, proprietary form of organizations hereby was replaced by partnership enterprises. Definition: according to section 4 of the Indian Partnership Act, partnership means the relationship between who have agreed to share profits of a business carried on by all or any of them acting for all. Persons who have entered into partnership with one another individually are called partners and collectively are called a firm, and the name under which the business is carried on is called as a firm name. Essential features of partnership: a partnership business must satisfy all the elements, they must exist together. Number 1, contract, that is, it is an agreement entered into by all the partners. Number 2, a business, that is, a lawful business. The term business includes every trade, occupation and profession. For example, a polyclinic can be started by 2 or more doctors on the basis of the partnership. Next, profit sharing, that is, sharing of profits or losses in the business. Next, mutual agency, that is, the business is carried on by all or any of them acting for all. An association of 2 or more persons. The number of persons constituting a partnership must not exceed 10 in case of banking business and 20 in case of another business. Objectives: the objectives of the study are to understand the meaning of partnership, next to appreciate the importance of partnership deed and to state the various modes of dissolution of firm, and to explain the meaning of certain key terms. Also to state the rights and duties of a partner. What is the meaning of partnership now? Partnership form of business organization came into existence on account of limitations of sole proprietary concerns. The major limitations of sole proprietary concerns are those of shortage of funds, uncertainty about existence, unlimited personal liability, etc. In case of a partnership business, 2 or more persons join hands together to do a business. Thus, the risks, funds responsibility all are shared. The Indian Partnership Act 1932 is applicable to contract of partnership. Importance of partnership deed. Partnership is created by an agreement. It is not necessary that the agreement should be in writing. It may be oral, but to avoid future disputes, it is always better to have it in writing. The document in writing containing the important terms of partnership as agreed by the partners between themselves is called the partnership deed. It should be properly drafted and stamped according to the provisions of the Stamped Act. Now, what are the contents of the deed? Contents of the deed. The deed usually contains the information as name of the firm, name of the partners, name and the place of the business and the firms, date of commencement of partnership, duration of the firms, capital employed or to be employed by the different partners, rules regarding operation of bank account, what should be the ratio in which profits and losses are to be shared, how the business is managed, salaries etc. if payable to partners, interest on partners' capital, loans, drawings etc. to be allowed or charged, settlement of account on dissolution of the firm, and finally arbitration clause is also applicable. It is better if the deed is very elaborate and clear about all questions which may arise in the course of partnership. In the absence of any agreement, the rights and duties of the partners will be those which have been given in the Partnership Act 1932. Provisions affecting accounting treatment. The partnership deed is very elaborate. It covers all matters affecting the partnership business. However, In the absence of any provisions to the contrary, partnership deed agreement, the provisions govern the accounting treatment of certain items such as rights to share profits. Partners are entitled to share equally in the profits earned and contribute equally in the losses incurred. Likewise, interest on capital. No interest is allowed on the capitals contributed by them. Similarly, no interest is to be charged. However, where partnership agreement provides for payment of interest on capital, such interest is payable out of profits of the business unless otherwise provided. Interest on advances. A partner who makes an advance of money to the firm beyond the amount of his capital for the purpose of business is entitled to get interest at the rate of 6% per annum. Rights to share subsequent profits after retirement. Where any member of the firm dies or otherwise cease to be a partner, the surviving or continuing partners carrying on the business of the firm with the property of the firm without the final settlement of accounts as between them. The outgoing partners or his estate is entitled to such of his share in the property of the firm or to the interest at the rate of 6% per annum on the amount of his share in the property of the firm. No remuneration for firm's work. A partner is required to attend diligently to his duties in the conducting the business of the firm. He has no right to receive the remuneration or salary for taking part in the conduct of the business. Rights of partners. Every partner has the right to take part in the conduct and management of the business according to section 12A. Every partner has a right to share equally in the profit of the business earned according to section 13B. Every partner has the right to have assess and inspect the books of the firm according to section 12D. Every partner has the right to be indemnified, that is, security against anticipated loss by the firm in respect of payments made and liabilities incurred by the firm. Every partner has a right to be heard and to be consulted before any matter of difference is decided which affects the business of the partnership. He has the right to express his opinion. A partner is entitled to interest at 6% per annum on any payment or advance made by him beyond the capital he has agreed to subscribe. A partner has the authority to act in an emergency to protect the firm from losses. A partner has a right to retire by giving notice in writing to all partners of his intention to retire. He has right to use partnership property for the business purpose according to section 15. To have the business wound up after dissolution and pay off liabilities out of the assets released. Now, what are the duties of partners? To have good faith on himself and that of others, to share losses of the business, to reimburse or indemnify for any fraud or willful neglect to business, to participate diligently in the activities of the business, to exercise the given authority for the benefit of the firm, to work within the framework of the authority given, to account for any personal profit, to account for any profit if the partner is engaging in a business, to utilize the property of the firm for the firm's business only, not to claim any remuneration unless it is expressly agreed. Now, what are the relation of partners? Relation of partners to one another and third parties. Here we are going to discuss about rights, duties and liability of partners. Persons who join hands together and agree to do business in partnership should have a bond of mutual trust and confidence between each other. In case of any differences arising as the ordinary matters connected with the business between the partners, the majority decision is carried out which is binding on the minority. The majority decision must be made in good faith with a view to the collective interest of the firm. However, when unanimous consent of all the partners is required, then the partners have to confirm together. For example, nature of business, admission of new partner, transfer of partner share. Constitution of partnership firm can be changed only with the unanimous consent of all partners. The mutual rights and duties of the partners of a firm may be determined by contract between the partners. Such a contract may be expressed or it may be implied. Express contract. When the terms of contract are in writing, it is called as expressed contract. Implied contract. The terms of contract are inferred from the conduct or dealings between the parties. When the proposal or acceptance of any promise is made other than in words, the promise is said to be implied. Such an implied promise leads to an implied contract. For example, Mr. A boards a bus. It is implied from his conduct that Mr. A has entered into an implied promise to purchase a ticket. Such a contract may be by express or implied consent of all the partners. For example, partners may decide upon the profit sharing ratio, amount of capital contributions, work allocation, interest or loans, etc. In the absence of express contract between the partners, the relations between the partners are governed by section 9 to section 16 and section 25 of the Act. Minor admitted to benefits of partnership. As explained earlier, that the relationship of partnership arises from a contract. Thus, only those persons who are competent to make a valid contract can become partners in a firm. According to section 11 of the Contract Act, a minor is incompetent to contract. Therefore, a minor cannot become a partner in a firm. However, with the consent of all the partners, a minor may be admitted to the benefits of partnership mentioned under section 30. Section 30 therefore, as a rule, bars the entry of a person who is a minor to become a partner in a firm. The second part of section 30 opens the door for the person who is a minor to become a partner in a firm. A minor may be admitted only to the profits or benefits of the partnership with the consent of all the partners of the firm. The guardian of the minor enters into an agreement with other partners on behalf of the minor. Under any circumstances, a minor cannot be made a party to the liabilities of the firm. Now, what are the rights of minor? They have to share profits, to have access to accounts, to sue for accounts only on serving his connections with the firm, to elect to become a partner, to elect not to become a partner. Dissolution of partnership firm. Further, let us understand the term dissolution and various modes of dissolution. The term dissolution stands for discontinuation under the Partnership Act 1932. The dissolution may be either of partnership or of firm. It should be noted that there is a distinction between dissolution of partnership and dissolution of firm. Dissolution of firm means complete breakdown of relationship of all partners. However, if this breakdown is relating to few partners and the partnership is continued, it is known as dissolution of partnership. Dissolution of partnership is mere reconstitution of partnership. The causes of change may be due to admission, death or retirement of partners. Modes of dissolution. There are various modes of dissolution of partnership firm. Let us understand the grounds of dissolution with or without the intervention of the court. First, dissolution without the intervention of the court. A. Dissolution by agreement. A partnership firm comes into existence by mutual agreement and therefore, it can also be dissolved by mutual consent of all the partners. B. Compulsory dissolution. A firm is compulsorily dissolved under any of the circumstances. when all partners or all partners is adjudged insolvent, or where unlawful business has been carried out due to happening of any such event. On the happening of certain contingencies, in the absence of any contract to the contrary, a firm will be dissolved in the happening of any of the events. On the expiry of fixed period for which the firm was constituted, on the completion of the adventure or undertaking of the firm, or on the death of a partner, or on insolvency of partners. Dissolution by notice, where the partnership is at will, the firm may be dissolved by any partner giving notice in writing to all other partners of his intention to dissolve the firm. The firm will be taken to be dissolved from the date as specified in the notice. Next, dissolution by the court. There are cases where a court on a suit by the partners will intervene and may order for the dissolution of the firm. Insanity, when a partner has become of unsound mind, lunacy of a partner does not dissolve the partnership, but it be a ground for dissolution at the instance of the other partners. Next, permanent incapacity. When a partner other than the partner has become in a way permanently incapable of performing his duties as a partner. Next, misconduct. When a partner has committed a misconduct of business which is directly connected with the business, for example, conviction of a partner for travelling on the railway without ticket with the intention of defraud. Next can be breach of agreement. When a partner persistently commits breach of an agreement regarding the conduct of business or the management of business affairs, court will intervene only where the breach of agreement relating to business destroys the mutual confidence between the partners. Next, loss in business. When the business of the firm cannot be carried on due to loss in the business, all the points explain the circumstances where the court intervenes in dissolution of partnership firm. Next, how do we settle the accounts? Further, let us understand how accounts of the partners are settled after dissolution of the firm. The Partnership Act incorporates various sections, namely 48 and 45, laying down the rules of settlement of accounts and divisions of profits and losses after dissolution. Number 1, the goodwill of the firm shall be included in the assets and may be sold either separately or along with the property of the firm. Number 2, losses including deficiencies of the capital shall be paid first out of the profits, next out of the capitals, and lastly, if necessary, by the partners individually in the proportion in which they were entitled to share as mentioned in section 48A. Order of payment. The assumption of realization of all assets and the payments of all the liabilities as on the date of dissolution is far away from practice. In actual practice, the assets are released gradually and the cash is made available as applied in the given order. From the external liabilities, first pay the preferential liabilities, government dues such as income tax, municipal taxes, etc. Dues to employees such as outstanding wages, provident fund, etc. and realization expenses. The other liabilities may be secured or unsecured liabilities. Another point to be noted here is that in case there is more than one liabilities of same category, then the payment should be made on pro rata basis, that is proportionately. Example, bills payable and creditors are to be paid simultaneously in the ratio of the amount. After paying off all the external liabilities, payment should be made for discharging internal liabilities, that is loans from partners. Here also If there is more than one such loan, the payment should be made pro rata. When all the external as well as internal liabilities are settled, payment can be made to partners on their capital accounts. Let us look into what are the methods of distribution of cash. There are two methods. Number 1, surplus capital method, which is also called as proportionate or excess capital method. Second, maximum loss method or notional loss method. The surplus capital method is very simple distribution of cash among the partners. As the name indicates, the surplus capital of the partners is found out first. Under this method, the excess capital contribution by the partners with reference to the profit sharing ratio is determined. The partner with absolute surplus capital will be paid off first. The second method is maximum loss method. This is another method of distribution of cash between the partners. Under this method, each realization of assets is assumed as if it is the last realization and that the remaining assets are worthless and is not going to release anything. So, at every stage, the partners will share its maximum loss that they have to share and get the balance payment only if it is available. This method is also known as notional loss method. Assuming this most pessimistic situation, the loss is found out and the formula used is maximum loss is equal to total of capital balances minus available cash. The maximum loss is distributed among the partners in their profit sharing ratio and it is deducted from their capital balances. If the capital balance of any partner goes into negative, it is assumed that the partners having negative balance has become insolvent and his deficiency, that is negative balance on capital account, is borne by the remaining partners in proportion to their capital just before dissolution. Gardner versus Murray's rule states that after adjusting the negative balance, the remaining capital balance is to be paid off. Insolvency of partner and decision in Gardner versus Murray's case. Students should know and understand the concepts as under insolvency of a partner. If a partner's estate is not sufficient to pay off his dues to a partnership firm, he is considered as insolvent. This deficiency of insolvent partner is to be borne by solvent partners in their capital ratio as per the decision in Gardner versus Murray's case. Dear students, I hope you might have got the clear idea about what is the settlement of accounts, how the capital is distributed and what are the various rights, duties and liabilities of the partners. Thank you.